Hi, my name's Scott Dahl. Thank you for joining another one of my podcasts. Where are we at now in this volatile market? Let's take a look at it. So I'm a technical analyst. I've been reading charts for close to 50 years. I'm a chartered market technician. It's the highest accreditation you get in the field of technical analysis. I earned that in 2001. Technical analysis is my primary tool, and what it does is it gives me a pictorial. Everything that's happened in a stock or in a market is in this chart, and it gives me the ability to see what's happened and to see if I can recognize patterns with other tools to try to see where we're at in the current market and what to do with the money. I will tell you right now, and I've said this throughout my entire podcast series, I believe we're in a cyclical bull market and a secular bear market. The secular bear market is going to be punctuated by high inflation, high interest rates. The previous podcast, I lay that out for you in more detail in podcast 5, or the initial start of my podcast. It explains this and why it's time for a high inflation, high interest rate secular, a long-term bear market. We're still in a cyclical bull market, so let's look at this S&P 500. Last podcast, I gave a probable target of 5,036, which is right there. So I developed this target on the 31st of March, which is right here. And what I said was, this is a bearish pattern, it's an inverse flag, and that it projects down to 5036, which is right in this level. I also said that if we go through this long-term trend line, then this potentially no longer a cyclical, a shorter-term bull market. It's now turning into a bear market. So what happened? We went through the line. We were down there for a few days below this trend line. Then we with incredibly large volume, a lot of participation, we just skyrocketed higher. This is called a breadth thrust. Now, on the way down, the S&P 500, we'll use this as an example of the market. The S&P 500 made two gaps, and I'm going to blow this up so we can see it. So it gapped here and it gapped here. Gaps are very bearish when you see them on the downside. There's an old adage: the market typically fills its gaps in 3 days, 3 weeks, or 3 months. I've never really researched the validity of this, but I will say that it takes a lot of momentum to fill gaps. When you have gaps on the downside, they're bearish. Well, we filled the second gap, but we haven't filled the first gap. I'm blowing it up further. So this. We gapped down here, we gapped down again, we came up off the bottom in a strong fashion. We filled this first gap, but we did not fill the second gap, and that's a bearish sign. So now we're selling off again, and there's a very high likelihood that we'll go down and we'll test this trend line again and possibly even test these lows. Also, I want to point something else out. I talked about Fibonacci retracements in 1 or 2 podcasts ago. I said we've got support here, which is 38% back from the top. We've got support here, 50% back, and then support here at 0.618% back. These are measurements from the start of this bull market, which started in November of 2022. Well, what we did is we stopped. We stopped at this 61.8% back, and we bounced off of it. So we're still in a cyclical bull market. We're going to go down probably, not guaranteed, we're probably going to go down and test this area down in here. If we close below this trend line again, or if we take out the lows, then the cyclical bull, definitely it would be challenged to think that we're still in a cyclical short-term bull market. One thing I do want to point out too is a bear move, or this sell-off, this correction. I still believe it's a correction at this point. This correction has lower tops and lower bottoms, lower tops and lower bottoms, lower top. The weight of the evidence suggests that we're going to go lower and test these lows. Okay, let's take a look at breadth. You all know that breadth is the lifeblood of the market. That's one of the most important things in technical analysis. You want the breadth, which is part of the stock participation. You want it to be moving higher. That shows internal strength in the market. This chart is a measure of breadth of the New York Stock Exchange. That traditionally is what was used as a breadth measure. So this is a traditional measure of breadth, and you can see that the breadth is continuing to travel lower, which means less and less stocks are finding their footing, and that is also a negative sign for the market. And we would expect that the breadth would come down to this first Fibonacci retracement. It might come down to the bottom and hold there, but the bottom line is the market's going down and breadth is shrinking, and that's a bearish development. So I want to put up one more chart, and because this is such an important index, we relied on technology stocks, predominantly the top 7 technology stocks to drive the market for the last few years, and that's what occurred. So now it appears that they might be failing. So let's look at the NASDAQ, which is a predominantly technology index, and let's see what's happening to the technology stocks. You have basically the same thing. You had a sell-off from this inverse flag. You had the sell-off. You had a recovery from here. Now, the positive news is the NASDAQ, the technology, filled these 2 gaps. That's a technical positive, but it looks like we're still in an exhale here. So unless we get the breadth to turn around, the probability is we're going to go down and test those lows. What you want to do right now, you don't want to knee-jerk out of this. The volatility is painful. Everybody's focused on it, but that's the price you pay to make long-term money in the equity markets. But you want to look at your portfolio and you want to pick out those losers. You want to get the losers out. The weak stocks relative to the other stocks have less of a likelihood of recovering. And you want to position your money or move your money into not only the strongest asset classes, be it commodities, international U.S. stocks, you want to move it to the strongest asset classes, the strongest sectors, and then you want to make sure that you are in the strongest securities, what's holding up the best, because when we see the recovery or a continuation of this cyclical bull market that I believe we're still in, when we see this recovery, then you're going to have the winners. And what's holding up now, that in all likelihood from past experience is what's going to be the winners. So if you want me to take a look at your portfolio, I'd be happy to do it. Give me a call. It's 949-497-6366. It's Scott@DollarCapitalAdvisors.com. And thank you again. I look forward to putting one of these up in the future. So hang in there. Call me if you have any questions. Thank you.